My favorite fund managers on the show today, Rajesh Kothari of AlfAccurate, who has a knack of picking bigger themes, and then, of course, within them, stock picking is his day-to-day stuff. Rajesh, good afternoon. Thank you so much for your time. We are chatting up after a long time. Let's build upon this point which you have shared with us that actually India could turn out to be the breakout market for this decade, and probably that's the reason you have high capex kind of stocks mostly in your portfolio, or a very good dollop of that in your portfolio. If you can expand upon that argument.
I think Ajay is actually very simple. If you wants to take view on market, there are four questions one should ask yourself. The first, what is our growth? That's most important. So if we look at the India growth, at least 6.5%. Of course, the recent number is pointing towards 7.5. Even if you assume 6.5%, in an environment where world is entering into a slow lane, Japan is struggling, China is struggling, entire Europe, EU is struggling, US is trying to do a little bit better. So the world is growing at 3, we are growing at 6.5, double the pace of growth of world. If world does little better, we can further improve upon. So that's first point. Second point is, what is this growth is coming from where? Is it coming from higher credit, or is it coming from unleveraged balance sheet? The answer is corporate India is repaid more than 2,50,000 crores despite COVID 2 years. It means the growth is very, very healthy. It is driven primarily by the internal accruals. In fact, one of the critics, somebody said FDI in India is not so strong. But actually, if you look at into the corporate India balance sheet, probably we don't need FDI. They don't need FDI because they are flushed with funds. So the growth is driven by internal accruals. Third is, what is the consistency of the growth? For the first time after 2002 to 2006, which was a golden period of Indian economy, and for the market, Sensex became 5 times in 5 years. For the first time, the Nifty has delivered 15% plus double-digit growth, not for 1 year, not for 2 years, not for 3 years, but for the 4th consecutive year. This has never happened before. And last but not least, what is the outlook on the growth? So if you keep growing at 6.5%, it means nominal GDP growth is 12%. It means organized sector can grow their revenue by 13-14%. It means some benefit of operating leverage. So profit growth can be 14 to 15% over a long-term basis, on a compounding basis, which is again one of the highest in the world. So if answer to these four questions are yes, then it is all about we are in a structurally bull market. No doubt, corrections will be part of the market. And therefore, you keep looking at valuation, you keep looking at the pockets of opportunities, and that's how you keep building the portfolio. But overall, we are in a structurally bull market. And with 8% GDP growth number, if it sustains, then I will not be surprised that the returns can be much better than probably what India has seen in last 10 years from the equity market perspective.
Okay, let's build upon this a little more. Rajesh, I want to understand that this point is well established now. What are your thoughts on the valuations of the capital goods space right now? Because they went to a bit of a sideways correction, because after doing a very good run, depending on which stock are we talking about, the minimum was doubling, some of them quadrupled as well. Are the valuations back in comfort zone? How does the investor actually tackle this issue, that this is a very strong theme, very broad-based theme, but sometimes stocks actually become expensive here?
Ajay, the valuation is a function of growth. Look at the top 10 companies in capital goods space and look at their market cap from 2010 to 2019. I'm not looking at March 20, which was a suppressed number due to COVID. For 10 years, the market cap growth has been 0%. For 10 years. Because the earnings growth was 0% or negative. From that 0% earnings growth, now we are going towards 25 to 30% growth, because it is cycles. And cycles produce very high growth or probably degrowth or flat growth. And look at the number of new drivers which are resulting into this growth. It is just not from building of roads or building of ports or building of railways. It is coming by the new growth drivers, be it a data center, be it a smart grid, be it a automation, be it a process efficiency, be it a new EMS opportunity, electronic manufacturing opportunity. And further, it is supported by the PLI efforts of the government, Make in India efforts of the government. And on top of it, for the world supply chain, India is becoming important, be it Europe plus one or be it China plus one. So the entire thing, the confluence of factors are working in your favor. And when confluence of factors works for your favor, the growth becomes extraordinarily high compared to what it should be. But that's how the cyclical stocks behave in terms of their cycles. And therefore, in capital goods space, please don't look at the valuations at first go. First, you need to look at the order intake growth. Because if the order intake growth is strong, the profit growth is after next 2 years. So valuation will always look artificially high or artificially low. That's not the right way to look at it. Valuation is all about the order intake growth. So if you are bullish on India, if you believe the data center capacity will become 5 times in next 5 years, if you believe that the huge PLI benefit will result into significant manufacturing growth, then the order book growth will be 18, 20, 25, 30% for the next 3, 4, 5 years. And if that's your thesis, then valuation will also reflect the same. It will remain at higher level because growth is at higher level.
Rajesh, I also see you're bullish on real estate now and for some time. I want to understand now, at least for the very high degree of premium luxury real estate, one is getting a sense that prices are kind of hitting a ceiling. At least in Mumbai region, one can talk about it. So much oversupply is there. I want to understand what phase of the real estate cycle are we in, and could it become a bit of a roadblock if so much supply actually comes in?
I think two important things, Ajay, as you rightly mentioned. Typically, the real estate cycle is for 8 to 9 to 10 years. These cycles are for 8 to 10 years. These are not 2 year, 3 year cycles. So that's number one. Number two, our approach within real estate space is to play through the real estate beneficiaries rather than play direct in a big way. So, for example, be it a building material companies, be it a wire and cable companies, or in all the related entities. It can be tiles, it can be plywood, it can be pipes, it can be paints, it can be wire and cable, and so on and so forth. And that's where we see the lag. Am I right? A typical real estate demand, when you look at the registrations, same registration will come for the interior after 4th year and 5th year. So probably now we are entering into a very good cycle for the building material over next 2 to 3 years, and we are watching that space, and probably we would have some exposure. We are already having good exposure in the last 4 years in this entire proxy real estate space, and probably we would again add a few important names in this space over next 6 to 12 months.
Right. Also, areas of the market which you are still not comfortable in, like chemicals. I mean, I remember you have played this theme early on, then it went to a variety of issues, it went to a very big correction, and every time now people are saying that perhaps the time is ripe to get in. Would you be cagey about it, or would you start building somewhere, at least thinking that 2-3 quarters far out pricing and dumping by Chinese, all of that may reverse?
Well, I think as I always say, the exit strategy is as important as entry strategy, and thankfully we exited at the right time. March 2023, almost we made it zero over a specialty chemical exposure. We are monitoring that space. There are a few interesting names within that where we are becoming a little bit more positive. We have not yet taken any exposure to that, but I think the China story is still against us. And whenever China does something, they do it on scale. And when they do it on scale, it becomes a problem from the pricing perspective. So I think I think it is still wait and watch kind of a mode for us. We are watching it very closely. The valuations are not corrected while the growth has already corrected. That's another problem in specialty chemicals. So you are not getting companies at 15, 20 PE. The good companies are still trading at 30 to 50 PE. However, the growth, unlike capital goods, where I said the growth is very high, here the growth has been significantly impacted. And there is no visibility that it will continue to be so or not. So I think it is a very, very tricky situation right now, specialty chemical. It is a very complex situation. And again, one needs to be into specialty side of it rather than commodity side of it. And that's where basically 1 or 2 stocks, we are in the, what I would say, in the finalization stage from the evaluation perspective. And once the valuation turns a little bit favorable, probably we'll take some exposure to it.
Just one last word, Rajesh. Last week, be it the regulator commentary, be it generally, the big HNI loading up way more than what they can handle the volatility of, whatever reason, the mid cap, small cap part of the market went through a bit of a shake off. What are your thoughts now? Are the valuation of that pocket back in order, or you think some more sideways to corrective kind of can continue in the market?
Ajay, you'll be surprised to know that when you look at BSE Mid and Small Cap Index, which is about, I think, 1100 stocks, which is up roughly about 57 or 65% April to February. 30% of that, 25 to 30% of it is actually the large caps within Mid and Small Cap Index. So if you run actually attribution analysis, you will come to know what is actually moving and what is not moving. There are so many good mid and small cap companies, actually they have not moved. This entire mid and small cap index, they are driven by a few specific pockets. There are few specific, be it large or be it mid, but they are part of mid and small cap index, whether we like it or not. And that's what is basically driving it. So clearly, I've been saying that SME is one segment where I think valuations are absurd. And definitely it has to correct. The micro cap is a segment where valuations are definitely higher side compared to what it used to be. Definitely, I think correction will come. But overall, if you talk about the top 500 companies, because when you say small cap, there are 5,000 companies listed in India, so you don't know what we are talking about. But if you talk about top 500 companies, I don't think valuations are that unreasonably high, considering the growth, considering the improvement in return on capital employed, and considering the overall balance sheet health. The valuations are okay. Of course, there are pockets where it's a little bit higher than 10 years average, and there are pockets where it is kind of a fair valuations. So what we are suggesting is that there is a possibility of time correction, there is a possibility of some price correction, and both are very important for the healthy market behavior. So it's okay. I think these are parts of life. After 75% up, you should not expect next year to be again 75%. So definitely it will moderate. So there can be time and price correction, but as a theme, when we look at our companies, the top 500, 600 companies, that's basically the universe one should focus on. And there are enough opportunities over a period of time. One can do probably, that's what we are suggesting investor to stagger their investment in our budding beast, which is our mid and small cap offering, rather than doing the lump sum. But otherwise, as a theme with a 5 years view, I think this will continue to deliver reasonably good returns to the investors.
All right, Rajesh, always wonderful and very educative interacting with you. Thanks very much for your time this afternoon as well. That was Rajesh Kothari of AlfAccurate.
If you like this video, then like, share and subscribe to ET Now.